Welcome to this explainer. Today, we're unpacking an absolutely massive shift in the tech world. Everyone's been calling DeepSeek's recent announcement a price cut. But honestly, it really isn't just a sale. What we are actually looking at here is a controlled demolition of the entire AI industry's valuation model. We're going to look past the flashy headlines and dig into the real numbers buried inside this announcement. Because trust me, once you see the underlying math, you'll understand exactly why every major AI lab out there just had a very, very uncomfortable Monday morning meeting.
Now, I'm sure you saw the headline number floating around. DeepSeek permanently locked in a massive 75% discount on its flagship V4 Pro model. Big deal, right? I mean, companies run promotions all the time to get developers hooked on their ecosystem, but almost nobody noticed the true industry-shaking implications quietly hiding in the math of this specific announcement. So to really get why the 75% number is so incredibly disruptive, we have to look at exactly how it was rolled out.
Let's rewind just a bit to late April of 2026. DeepSeek launches V4 Pro. And let's be super clear, this is not some lightweight experimental toy model. We're talking about a massive mixture of experts architecture with 1.6 trillion total parameters and a 1 million token context window. On pure world knowledge benchmarks, it claims to beat literally every other open source model out there, trailing only Google's proprietary Gemini. Now, at launch, they priced it at a premium. Then they offered what looked like a completely standard, temporary 75% discount, which was scheduled to expire on May 31st. But then, totally out of nowhere, on May 22nd, they just deleted the expiration date entirely.
Just like that, poof! By deleting that expiration date, DeepSeek effectively transformed a temporary promotional sale into a brutal, permanent new price floor for the whole sector. The promotional price just became the price. We are now looking at 87 cents per million output tokens and input tokens as incredibly low as a fraction of a cent, specifically $0.0036 per million on cash hits. No reversion planned, no fine print, and this is an absolute game changer because setting a permanent new price floor is a heck of a lot harder to walk back than just throwing up a catchy headline about a summer sale.
All right, let's dive into part one, this subsidy myth, a very comforting narrative.
Right after this dropped, Western investors immediately started telling themselves a really tidy, comforting story to make sense of these shockingly low numbers. The word on the street was, well, they're just Chinese state subsidized, or they don't actually care about profit. And you can see why they say that, right? Chalking this massive price drop up to a subsidy allows investors in companies like OpenAI, Anthropic, and Google to keep their existing sky-high valuation models safely intact. If it's just a government subsidy, they can tell themselves it's not a real market signal, and they can basically just ignore it.
But here's the catch. That tidy little story completely falls apart under scrutiny. When you remember that subsidies are temporary by nature, the whole logic just crumbles. I mean, why would DeepSeek bet on this pricing being permanent, in public, with zero expiration date barely a month after launch? Subsidies eventually get pulled when the money runs out or political priorities shift. Making a highly public, permanent pricing commitment like this is a completely different, much more calculated, and frankly, a much more dangerous bet for all their competitors.
So what's really happening? That brings us to part two, the hidden math and the reality of a cost structure war. To figure out why the whole subsidy excuse isn't the full picture, we have to look at the real reason for those emergency board meetings. DeepSeek didn't just slash their profit margins to buy up market share. They fundamentally cut their underlying operating costs. Because of U.S. export controls making high-end Nvidia silicon so difficult to get, DeepSeek leaned heavily into running V4 Pro on Huawei's Ascend 950 chips. They've actually been super open about this, stating they expect infrastructure costs to just keep falling as Huawei ships more of these supernodes throughout 2026. They built on a cheaper chip stack, their unit costs came down way faster than expected, and they are literally passing those hardware savings straight through to the customer. When we actually do the math on the pricing, the reality becomes very, very uncomfortable for the big incumbents. Take GPT-5. That sits at $2.50 for input and $10 for output per million tokens. Claude's premium tier, roughly $5 for input and $25 for output. Now look at DeepSeek's new permanent pricing, roughly 43 cents for input and 87 cents for output. Against the premium US labs, we're staring down a stark 6 to 11 times cost gap. Even when you compare it against Google's absolute cheapest, most cost-optimized Gemini tier, DeepSeek is still meaningfully lower on output costs.
By passing these massive hardware savings directly to the consumer, DeepSeek has provided a highly public counterexample to a deeply held industry assumption. The entire pricing structure that OpenAI, Anthropic, and Google have built their massive business models around fundamentally assumes that frontier-quality AI inference has to inherently cost what Nvidia-based compute costs. But DeepSeek just showed the market its hand, proving beyond a doubt that frontier-quality inference simply no longer requires those exorbitant US compute costs.
Which leads us perfectly into part 3, history repeating itself. It's the same movie, just with new actors.
If this aggressively falling cost structure feels a little familiar to you, well, it absolutely should. Think back to the cloud computing wars of the early 2010s. You had AWS, Azure, and Google Cloud fighting bitterly to drive down unit costs and pass them through without bleeding out. Whoever got their cost structure dialed in first set the pricing floor that everyone else was forced to match. We saw streaming media do the exact same thing a few years later. And now, AI inference is entering that exact same ruthless phase. Pricing power always inevitably gets dragged back toward whoever has the absolute lowest actual delivery cost. And right now, the company setting that new floor isn't one of the US incumbents.
So, let's talk about the real-world impact in Part 4, the market fallout. Who is actually losing sleep over this massive shift? Well, the fallout hits 3 main groups incredibly fast. First up, this puts immediate crushing pressure on mid-tier labs like Kimi, Qwen, and Minimax. They now have to try and justify their prices against a frontier-class model that's running at a mere fraction of their cost, which is going to lead to severe margin compression. Second, chip makers are getting a harsh reality check. Sure, Nvidia's massive software and distribution lead isn't going to collapse overnight, but DeepSeek just showed a very visible crack in the assumption that Nvidia is the only viable chip option at scale. And third, and perhaps most importantly for retail investors, this directly threatens the big US AI labs. Their sky-high revenue multiples are entirely based on the AI moat thesis, the assumption that inference stays expensive, justifying their premium API margins. If those underlying costs collapse, those billion-dollar valuations get very shaky very fast.
Now, to be completely objective, let's look at Part 5, the counterpoint, or the skeptic's view.
We always have to look at all angles here, because skeptics do have a really legitimate point. The simple fact is, nobody outside of DeepSeek can independently audit their actual hardware and operational costs. The numbers are just made up as a real, valid limitation when you're dealing with private companies. It is entirely possible that this whole thing is simply an Uber-style blitz to buy up market share. We've seen companies go years heavily subsidizing their own growth before the bill eventually comes due, much like the rideshare and food delivery industries did for the better part of a decade.
Yet, here's the honest, bottom-line takeaway. Whether they've truly innovated on cost, or if they are just heavily subsidizing growth, the result is exactly the same for the market. For the very first time, a frontier-class lab has publicly staked its pricing on this cost structure claim, with no expiration date in sight. The bet is squarely on the table. This move forces every single competitor in the entire market to respond to this new floor, completely regardless of whether DeepSeek's internal financials can actually sustain it in the long run.
So the next time you see a flashy headline about an AI price cut, I want you to look right past that sticker price. Ask yourself, what did it actually cost them to make that cut permanent? Does it reflect a genuine hardware innovation, or is it just a temporary, desperate grab for market share? Uncovering the answer to that question reveals exactly who is actually winning the AI infrastructure race. Always remember to keep looking under the hood. Thanks for joining me on this explainer, and I'll catch you next time.